Foreclosures have surged overnight, with a 34% increase, according to recent reports. Housing analysts have noticed a rise in foreclosures, and unfortunately, Las Vegas is at the forefront of this financial crisis. Mortgage rates have skyrocketed to over 8% for borrowers with perfect credit scores. This marks the fifth consecutive week of climbing mortgage rates. In fact, the 30-year fixed mortgage rate has jumped by 20 basis points. What does this mean for someone looking to purchase a $400,000 home with a 20% down payment? Well, they are now paying approximately $1,000 more per month than they would have just 2 years ago. For individuals with bad credit, the situation is even worse. The 30-year fixed mortgage rate stands at a staggering 9.1%. On top of that, home builder sentiment has hit a 10-month low, and the real estate market is heading into a storm. Despite this gloomy outlook, the real estate market is also presenting a significant opportunity for smart investors. In the coming years, particularly in 2024 and 2025, there is a real chance for savvy real estate investors to make a fortune. Millions of homes are expected to go into foreclosure, leading to losses for commercial real estate investors and landlords. Let's take a closer look at the situation. It's crucial to understand the facts and be knowledgeable about what's really happening. If you find this information useful, please hit the like button and share it with others to educate them as well. Now, let's examine the statistics. Home builder sentiment has dropped to a 10-month low, and mortgage rates have reached their highest point in 23 years, dating back to 2000. The 30-year fixed mortgage rate currently stands at 8%. Shockingly, even borrowers with an 800 credit score are facing an interest rate of 8. During the holiday season, people tend to rely heavily on credit cards for their expenditures, including travel and buying gifts. This leads to an increase in debt and late payments on credit cards. Consequently, credit scores nationwide are expected to decline, causing significant difficulties for individuals with bad credit who wish to invest in real estate. This situation is interesting because it coincides with a perfect storm in the real estate market. It is arguably the most significant downturn in U.S. history since the country's inception. For instance, home prices for a $200,000 house are plummeting, particularly in places like Camden, New Jersey, where homes can be purchased for approximately $150,000 to $200,000. However, these homes come with substantial monthly payments of over $2,000, assuming a 3.5% down payment from the Federal Housing Administration, FHA, and a bad credit score of 9.1%. Even with a good credit score of 8.2%, the monthly payment would still amount to $900, making it nearly impossible for individuals to afford a $500,000 property under these circumstances. As a result, sellers are likely to start pursuing potential buyers more aggressively. As the labor market deteriorates and inflation worsens, many people will struggle financially, which will lead to an increase in sellers and a shortage of buyers. Consequently, the basic principle of supply and demand will determine prices, resulting in a decline in property values. This trend is already noticeable in the rental market. In Florida, rents have already decreased by 4.15% year over year, with Miami experiencing an even more rapid cooling of rental prices. Similarly, rents in California have dropped by 2% statewide and over 4% in the San Francisco Bay Area. This shift is being observed nationwide, and it aligns with my prediction from a year ago that rents throughout the country would significantly decrease, leading to problems for landlords. According to recent data, foreclosures have experienced a sudden and significant increase, jumping by 34%. This trend is not limited to a one-time occurrence. Foreclosures seem to be steadily rising. The notion that there is a shortage of homes is a fallacy that has been perpetuated over the past few years. The truth is that the American people have been sold a massive scam. For instance, let's examine a location like Austin, Texas, which has been highly sought after. Despite the supposed housing shortage, there are a staggering 232,000 apartments available. However, an additional 120,000 units are being introduced to the market, which will lead to a 53% increase in the rental market by 2024. Consequently, we can expect rents to continue plummeting. This scenario is not unique to Austin. Markets across the country are experiencing similar circumstances. The job market is expected to worsen significantly due to the need to refinance $2 trillion in commercial debt next year. This will result in more layoffs and exacerbate inflation. Additionally, the ongoing geopolitical situations, such as the real Hamas situation and the Russia-Crayon situation, are likely to contribute to the escalation of oil and energy prices. This, in turn, will lead to higher costs for policyholders of insurance, including car and home insurance. Inflation will continue to rise, creating challenges for individuals with low mortgage rates who may struggle to weather the economic storm. The majority of people live paycheck to paycheck and cannot easily afford the rising costs of living. As expenses continue to increase, more individuals will reevaluate their spending habits. For example, if someone currently has a mortgage payment of $3,000 per month, but could rent a comparable property in the same neighborhood for $1,700 or $2,000 per month, they may choose to downsize in order to save $1,000. Given the significant financial strain many individuals are facing, it is not surprising that 40% of all mortgages in America were taken out in 2020 and 2021 during a period of record low interest rates. However, due to factors such as realtor fees, transfer taxes, and closing fees, many homeowners who purchased during this time would actually lose money if they were to sell immediately. Consequently, a large portion of the population is effectively trapped in underwater mortgages, leading to significant financial distress. The situation is also problematic for landlords who have invested in building multiple apartment complexes with the expectation that rents would continue to rise. However, with rents declining and borrowing costs increasing, along with rising insurance and tax expenses, these landlords now find themselves in a difficult position. Many will soon need to refinance their properties, exacerbating their financial burdens. To gain insight into the potential outcomes, it is prudent to observe the actions of institutional investors. For instance, entities like Blackstone, KKR, a private equity firm, and Capital, collectively controlling over 1 million homes in America, are significant players in the real estate market. These firms are currently sitting on a substantial cash reserve of $5.3 trillion. Notably, Blackstone recently raised a fund worth $30 billion and $400 million, specifically targeting single-family homes for rentals. Do you believe the housing market is on the precipice of turmoil and panic? Please share in the comment what you think about the current situation. Let's open a discussion.